Hello and welcome to my final recording of accounting financial ratios. And I hope you understand the importance of accounting ratios from the last video link that I sent. So this video will go into more detail and give you some examples to work with as well. Okay, so here I will share my screen with you so you can follow along as I go. All right, let's get started. Okay, so accounting ratios are very important because they help you to measure certain things, and if you can't or don't measure it, then you can't improve your business, right? So it's important to know what these accounting ratios are and how to calculate them so that you can see a trend and you can improve the performance of your business overall. All right, so let's look at the important financial ratios, and these are just some of them. Okay, these are the main ones. Number one is liquidity ratio, which measures how easily a company can pay its debts. Okay, number two, profitability ratios, which measure how good a company is at making money. And thirdly, leverage ratios, which is basically how much debt the company is using to make the company run and stay alive. So obviously, it's not very wise to have too much debt in order to run your company. All right, so those are the three main financial ratios, and each one will go into a little more detail. So here we go with one of the more important liquidity ratios, which is working capital. Okay, and working capital measures how much of the company's assets can be changed into cash within the next 12 months so that it can pay debts which need to be paid within 12 months. So basically, what we are saying is current assets divided by your current liabilities. And of course, you will want to have more current assets than current liabilities, right? So it's obvious that if the higher the working capital ratio is, the less risk it is for the company and the better it is for the company as well. Okay, so if your current assets is higher than your current liabilities, then your overall working capital ratio would be higher, which is a good thing for the company. All right, so let's look at a quick example here. And this is a balance sheet for XYZ, that's the name of the business. So if we look at this balance sheet, we would see the same headings more or less, right? Probably just in a different layout, but they are the same headings that we are familiar with. We have assets, we have liabilities, and we have owner's equity, right? So remember, we spoke about current assets, and they term it non-current assets or fixed assets, the same thing. And then we have current liabilities and non-current liabilities, also known as long-term liabilities. Okay, so we need to calculate the working capital ratio from this example. Okay, and we need then to figure out what is the total current assets from this example and the total current liabilities. So take a second to look at that. Okay, and from the sheet, from the example, you would see that this section here itemizes all the current assets. Okay, so 1,000, 3,200, 5,800 is 10,000. And your current liabilities is very clear over here, 20,000. So then what is your working capital ratio? It's simply the 10,000 divided by your 20,000, which is 0.5. Now, is this a good working capital ratio to have? What do you think? Well, since the current assets is less than your current liabilities, means that the company will have a very difficult time repaying debts that are due within 12 months, right? So this is not a good position for the company. If, however, the working capital ratio was 1.2, is that a better position than the 0.5? Yes, it is, because the higher the working capital ratio is, the less risk it is for the business and the better it is for the business. All right, now let's look at the leverage ratio. So the leverage ratio, a very important one, is the debt ratio. Basically, it's your total liabilities or your total debts divided by your total assets. And this indicates how much percentage of a company's assets are paid for by debt. Of course, you want to have a lower debt ratio because this is safer and better for the company. All right, so let's look again at this balance sheet. It's the same balance sheet, and we want to calculate the debt ratio. So the debt ratio, we need to figure out what is the total liabilities and the total assets. Can you tell me what is the total liabilities in this particular example? Well, the total liabilities would be the current liabilities plus your non-current liabilities or long-term liabilities. And in this case, it's 20,000 plus 440,000, right? And then your total assets is given to you in this block right here. All right, so it's 460,000 divided by 2.16 million. All right, and you can use your calculators to figure that what that debt ratio will be. It's 21%. Okay, so if another company had a debt ratio of 50%, which situation is better? A debt ratio of 21% or a debt ratio of 50%? What do you think? Well, that ratio of 21% will be better for the company because it's lower and safer. All right. Okay. So far, so good, right? Okay, let's continue with profit margin. And these two ratios are very simple. It basically tells you how much profit your company earns compared to sales. So your gross profit margin ratio says gross profit divided by sales. And your net profit margin ratio says it's your net profit before tax divided by sales. The higher these two ratios are, the better it is for your company. All right, so let's look at this example over here. And we want to find your gross profit margin and your net profit margin for ABC Limited. So your gross profit margin again is your gross profit divided by sales. And in this instance, it's 700 divided by 1,000. So 700,000 divided by 1 million. And there you get 0.7 or 70%. All right, and let's go back to your net profit margin, which is your net profit before tax divided by your sales. Okay, so that figure is 530 divided by 1,000, or 530,000 divided by 1 million to give you 53%. So if a company had a gross profit margin of 50%, which one is better? Well, the one of 70% will be better because it's a higher gross profit margin. And the same thing would apply for the net profit margin. Okay, so those are the main financial issues that you need to know. I hope it was understandable. I hope it was simple enough. Feel free to message me with any questions that you may have. I would attach a document so that you can get more practice with these financial ratios. And I look forward to seeing your responses on the classroom page. Okay, so thank you again for being part of this course. I enjoy sharing all of the information with you, and I hope it was beneficial to you. I hope to see you again in some of my other courses, and till next time, bye bye.